Hello, friends. It's Norman. Today, we are going to break down and explain ULTY as a fund, what it holds, its strategy on how it can pay out such great distributions, and determine which investors it is for. As we jump right in, ULTY is an actively managed fund that owns and holds 15 to 30 volatile ETFs and stocks. Implied volatility, meaning the predictability of the stock is very difficult to determine. It's going up and down very radically. And with that volatility comes um, a higher reward if you were making bets on it. So the primary goal is to generate weekly income from those option premiums when we sell covered calls. And the secondary goal is to participate in any price appreciation of those underlying stocks, although it is somewhat capped with the covered call strategy. Now, what is in the ULTI portfolio right now? It's a somewhat diversified portfolio of the most volatile stocks in the market. You can see that we have Coinbase and MicroStrategy here participating in the crypto and Bitcoin volatility. We've got quantum computing and AI stocks, as well as you know space exploration. So pretty good diversified portfolio here. 36% in tech, 31% in financials, 10% communications, 9% industrials, and 14% other sectors. Now, why does Ulti pay out such good distributions is it runs a collared option strategies. First, they sell covered calls on the stocks that they own. So, a covered call strategy, essentially, you are the casino and you are selling contracts or bets that uh, gamblers want to speculate on how high a certain stock or ETF will go. So, for example, if you have $100 and a gambler wants to bet that it will go past $110, you can sell them that bet as the owner of the stock, and you get a premium for creating that bet. Now, the best case scenario, the stock goes up, but under that 110 strike price. If it goes past that 110 strike price, the casino loses. If it stays under that 110 price, the casino wins. You keep the premium and you can place another bet after that. So that's how Ulti is creating its income with a new change of buying the downside protection. So Ulti now buys protective puts as insurance for the downside risk. They are, purchasing puts against that cover call strategy. So in case the stock just tanks, that it captures some premium to offset that loss in share price of the stock. Now, the ulti good versus bad, the pro and con. The good is that it is pumping out 80% plus annually at a weekly distribution rate. And that is certainly seductive. And it's why I'm interested in the fund. I love to see those weekly payouts hit the account. Gosh, it makes you feel real good. The other part of Ulti that is nice is the diversity and flexibility of the strategy. So they're selecting between 15 and 30, and it's more closer to that 30 range. And the flexibility being that they can self soothe the fund. If a stock is not paying out higher premiums for the option strategies, they can sell it and buy one that is uh, capturing that high premium. So the downside, the bad, is that you are essentially capturing a lot of downside potential with these highly volatile stocks. They can go down and go down hard like a rock. So that's why it's nice to have the protective puts. Like I was saying, it doesn't protect it 100%, but it is share price is going down. Okay. Another thing is the high fees. ULTY charges 1.3% expense ratio. And if you compare it to a indexed S&P 500 fund like Vanguard's VOO at 0.03%, it's a huge difference. So if you put $10,000 into ULTY versus the indexed VOO, it's a huge difference. $130 is what you're going to pay every single year on that $10,000 to manage it versus VOO, you're paying $3. So quite a big difference in the expense ratio, but you are paying the fund managers to execute a complex strategy. And that is a bad part of the fund is you are relying on these fund managers to make uh, calculated decisions on stocks that they think are going to perform well and pay a high premium. And hopefully they continue to do well with that strategy. Now, as ulti for you, it would be a yes if you're a more aggressive investor and you don't mind seeing red in your portfolio. Um, ulti is going to go down. It's going to have bad days when the market is having a bad day. And you have to be able to steel yourself in those times and stay calm and know that typically the market always recovers. It's going up and to the right eventually. So you have to have the stomach for that. You want that weekly income now as well. If you buy today, today's Monday, on Friday, you're going to get a weekly distribution. And if that's what you want, then Ulti might be up your alley. I also think that you have to be willing to reinvest a portion of the distributions. And if you listen to any representatives from Yieldmax, they talk about how they are supportive of the drip strategy and reinvesting a portion of your distributions back into the fund. I like to hold some of the distributions on the sidelines and buy dips and any down days in the market, put more into Ulti. Ulti would be a no for you, though, if you are a conservative investor and you don't like to see the volatility, you don't like seeing red in your account. If you don't have the stomach for that, Ulti is not for you. The share price is going to go down. Okay. If you're more interested in like long term, passive, buy and hold strategies, Ulti might not be up your alley. All right, friends, that's the breakdown for Ulti. You have to do more research. You can't just watch a few YouTube videos and then start investing. Please read the prospectus on the Yieldmax website and do your due diligence before you invest in these types of things. It is a high risk, high reward type of investing. Um, but that's all I've got for you today. Norman out.